One of the big areas of the market here that people are really questioning as well is private equity-backed credits, right? I mean, speaking of ways that people are kind of extending and trying to get past this era of maturing debt into a higher interest rate environment, you're seeing that very pronounced in the private equity industry. Would you bite on anything that they have to offer?
Well, right now, M&A transactions are extremely low. The volume's low. The multiples are about half of what they used to be in terms of what sponsors are willing to pay for assets. And importantly, the composition of debt is also low. And so all basically feeds into a very strong technical tailwind for leveraged credit and high yield in particular. To the extent that more M&A is on the horizon, and particularly sponsor-driven deals in the form of LBOs, those potentially could be attractive given the parameters I just described in terms of having lower levels of debt and just building in a higher margin of safety to those types of transactions.
Just about a minute left here, Sinjin, but what is your favorite trade in this market?
Right now, given the events that have transpired over the past couple of days, we do think it's important to start introducing interest rate sensitive securities and instruments or duration into portfolios. We've lived through a year of this holding pattern within markets where duration and interest rate volatility have been headwinds to especially fixed rate securities within portfolios. We would expect that that will now turn to a tailwind. At the same time, it's important to have a healthy dose of floating rate securities as well, simply to gather that carry that those offer as we head into the next chapter of this rate cycle.